We scoured 425 of the earnings calls that are in so far from the S&P 500, and we found that the mentions of inflation have ticked up. You can see here 33% of companies that have reported or had earnings calls have mentioned inflation. That compares with a 10-year average of 26%. So it's up a little bit. It goes up with inflation and mentions. The question is, does it lead? Here are the top sectors that we've seen it mentioned. And 65% of companies in consumer staples have mentioned inflation, 64% of industrials, 57% of materials. Now, the bottom three of the sectors, healthcare, very interesting. Not seeing a lot of inflation right there. Communication services and information technology. These sectors tend to have lower prices or even declining prices. Here's some of the commentary we came across. Chipotle. Oh, here's some of the companies. You can see the diversity of companies. Kellogg's, Ralph Lauren, Masco, O'Reilly Auto Parts, PPG. So the real spectrum of companies have been mentioning it. And here's some of the commentary we got. Chipotle says wage inflation is a bit of a wild card. We can't overcome that with transaction growth alone. That will require some careful timing and place in a menu price increase. Over at Ingersoll Rand, they're saying that the second half of the year has become increasingly inflationary since we updated our guidance in July. We are embedding the impacts of additional material and other inflation, tariffs, the knock-on effects of tariffs, into our forecast. So, Melissa, the question is, this data goes up when inflation is more of a problem. Question is, does it lead to greater inflation down the road?
Yep. Steve, come on over. We want to bring in Mark Zandi, the chief economist at Moody's Analytics, for his take on this. Mark, great to have you with us. You
guys got to get out of the city. I mean, that wasn't
you
that
see these
bad.
ticks all the time?
Yeah.
I mean, it's like old news. Show it again. No, I'm kidding.
In the suburbs. They got ticks in the suburbs.
When it comes to inflation, Mark, I mean, it behooves companies to say that these are costs that are rising, to sort of sandbag on guidance. And so what do you believe in terms of what companies are actually seeing in the pike compared to what you're seeing in the data?
Oh, this is real. I don't think they're sandbagging. Okay. Yeah, no, I think prices are rising, and for the things they're buying, the inputs into their whatever they're doing, and they're raising prices for what they're producing. Inflation is picking up. It's still low. It's very close to the Fed's target of 2%, but it's definitely picking up, and it will pick up more going forward.
Do you think that Powell's going to talk about this tonight?
I think he's going to say that inflation is at or near his goal and his target, and he's happy with that, and he'll, by implication, suggest that that is enough for them to continue to raise rates. And I think he doesn't have to talk about this as much as through his actions. The idea of them continuing to raise is sort of embracing what Mark is saying, because remember what's going to come down the pike in the next couple of months. You're going to have lower energy prices. And the question is, does the Fed look through that? And I expect it to look through that.
So, Mark, my notes say that you say that the economy is strong and threatens to overheat.
Right.
Why do you say that if most forecasters say that the economy's growth is actually going to slow as we move into 2019?
Well, it's going to slow because interest rates are going to rise because of the overheating. So it's a process, right? So here we are. The economy is very strong, growing above potential. Unemployment's low. It's going to fall further. The unemployment rate is 3.
So it's going to be overheating at the same time as it's slowing.
Well, no, it's overheating, and then interest rates start to right now. It's rip-roaring, 3% growth. Unemployment's falling. We're going to 3. Wage growth is picking up. I just said inflation is going to pick up. That's an overheating economy. Interest rates, the Fed's responding. Interest rates are rising. Long-term rates are going to also rise, in part because of the Fed and also in part because of the big deficits.
Does the Fed win this fight, and then does the economy go into recession?
Well, the metaphor is the Fed's trying to soft land the economic plane. The reality is the Fed has never soft landed the plane. So in my view, recession risks are very, very high. Not next year, because we're going to be still benefiting from the juice from the stimulus. But in 2020, when the stimulus goes away and we're left with higher rates, yeah, I think recession risks are very high.
So should the Fed be taking a different path than it's taking in order to avoid it? Is it avoidable?
Well,
can they do it this time?
Well, at this point, the die is cast. It's almost, it's once the economy goes past full employment, it's by definition, it's tautological. It has to come back to full employment. Otherwise, it just overheats. But let me just finish.
What's wrong with your idea here that the Fed has never soft landed the plane?
Let me finish this one point, because this seals it in the minds of people who don't think about this every day. If I'm going to a 3% unemployment rate and 4.5% is full employment, we can debate that, but most people think it's 4. That means I got to go from 3 to 4.5 without crashing the plane. That is incredibly difficult, and I would suggest almost impossible.
But it would be worse for the Fed to take their foot off the pedal in terms of being more dovish.
No, if anything, they've got to be more hawkish. I mean, if you're buying into what I'm saying, they got to be quicker and take more steam out of the economy now to try to forestall that overheating that's dead ahead of us. Yeah.
So I would just say the thing that's wrong with your idea the Fed has never soft landed the plane, which I love the idea that Power Lunch is now the place for ticks and plane crashes. I'm not sure that's the way we want to brand this show, but that's above my pay grade. But this is the thing. We've had two of the longest expansions in the post-war history, almost back to back. So I think that tells you that there's a lot of landings that happened that we may not really be accounting for here. So it's possible, I think, for the Fed to get out of this, and I think in the following way. One thing you see when you see these corporate earnings reports is companies are struggling with what to do before passing on these increases. They're trying to reduce margins. Some of them are forced to reduce margins. Some are boosting productivity. Others are looking for ways to do that. So I think there are ways to stretch the global resource system here without having a whole lot of inflation. So I think the Fed has some time to put some constraint on the economy, slow it down, and not necessarily cause a recession.
Just let me clarify. Every time the economy has gone past full employment, we can debate what that is, but every time it has never soft landed the plane. Yeah, you're right. We can come in things slow and ebb and so forth and so on. But once you go past full employment, particularly when you go way past full employment, we're going way past full employment, they've never soft landed that plane. And you're right, doesn't mean this is inevitable. Things happen. And you're right, we can have some luck on the productivity picture. But that, if you're a prudent planner, you don't plan on that. I mean, I say bring it on. Give me the productivity. Right now, the productivity growth is below what we've experienced historically, and we're expecting some miraculous, immaculate consumption. We're going to get a lot more productivity growth. Maybe, but I wouldn't count on it.